What's up, guys? Joe here with your first episode for 4 Minute Finance. So I'm going to be taking any questions you guys have on general financial questions, thoughts, strategies, and making them very simple to understand. 4 minute finance, right? In 4 minutes or less, not getting into the weeds, but knowing enough so that you can form your own opinions and make educated decisions in your own life, right? So we'll start very simple. Stock versus bonds, okay? If you invest in a company in the form of buying stock in that company, you are buying ownership in that company. You are becoming a partial owner in that company. Other words, though, you'll hear are shares, right? So you're buying shares, equity, right? Ownership, all the same thing. You're buying stock or ownership in that company. Why would you do that? You would do so with the expectation that that company is going to grow in value, right? Become more valuable, and that would be a good investment. Okay, one of two ways to actually make money off stocks are you can buy ownership into a company at a certain price point, right? Buy that stock for $10, let's say. Over time, that company becomes more profitable, more valuable. That stock price goes up. Maybe it gets to $20, and then you sell out. You give up your ownership, and somebody pays you $20 for your partial ownership in that company for the stock that you bought for $10. Right? On the other side, while you are an owner in a company and a company makes money, right, they're going to give their owners money, right? Profit. So they do that in the form of a dividend, right? They give dividends to shareholders when they see fit. Hey, we made a lot of money. We're going to give back some of these profits to our shareholders, right? You receive those checks in the form of a dividend check, okay? Flip side. Right, you can also invest in companies in the form of bonds. Right, what does that mean? That means that you are lending your money to a company or the government. Okay, so for example, a company wants to raise money. They're saying, hey, we don't want to give up any equity or ownership. We're going to issue bonds. Right, what that is, hey, you give me your money today, and me as the company or corporation, I'm going to promise you that we're going to pay you for letting us have that money a certain percentage. Maybe it's 3%, maybe it's 5%. We're going to pay you those in what are called coupons, right? You give me $1,000, we're going to pay you 5% or $50 in a coupon, right? Until maturity. At the maturity of that bond, I'm going to give you your full $1,000 back, right? But you also collected that 5% interest over that time period, okay? Now let's think from a business owner perspective, right? And an overall wealth building perspective, right? If I'm a business owner, I own Joe Incorporated, I'm 100% owner, and I want to raise money to grow my business, right? I need upfront capital to grow my business in a certain way. I could give up ownership by issuing stocks, right? And having the public buy equity or buy ownership, buy stock in my company, and I would give up some of that ownership, okay? Or I could issue a bond. I could say, hey, I don't want to give up any equity or ownership. I'm going to issue bonds. I'm going to then take that money, do what I will with it, whether it's hire staff or buy a new building or take some opportunity. I would do that only if my assumption is, if I'm making a promise for that bond to pay back 3% more than I borrowed from a particular investor, okay? My assumption is I'm going to take that money today, I'm going to grow my business by, let's say, 10% or 5% or 15%, but a number that I believe is going to be higher than the 3% I have to go and pay back for the amount that I actually borrowed, okay? That's all I got. We're at the 4 minute mark. Try to keep it simple. Please like, comment, share, ask questions. I'm going to be doing a lot of these, so feel free. Thanks. Have a good day.